Everyone thinks financial panics are sudden, lightning strikes from nowhere. But they're not. They're rehearsed. They repeat because someone left the script lying around. And the first draft was written in 1907. If you listen to the news today, you'll hear that regional U.S. banks are under pressure, or liquidity mismatches are causing stress. It sounds technical, harmless, like a plumbing issue. But under the surface, the same fault line that cracked Wall Street in 1907 is opening again. Only this time, it's hidden behind polished apps, insured deposits, and the illusion that the Federal Reserve can't fail. Here's the paradox. The panic of 1907 created the Federal Reserve, and yet the structure of that panic, how money fled from trust companies, how elites rescued themselves by centralizing control, is exactly what's repeating. We built a system to prevent the panic by institutionalizing it. Back then, it started in New York's trust companies, not the big banks, but the flashy newcomers. They promised higher returns, lent against assets no one fully understood, and grew faster than their reserves. When confidence cracked, withdrawals spread like fire. Within weeks, the entire U.S. financial system froze. J.P. Morgan, the man, not the bank, locked himself in his library with the heads of New York's major banks and decided who would live and who would die. The press called it heroism, but it was consolidation. Now, shift to 2024. Look at the names. First Republic, Silicon Valley Bank, New York Community Bank Corp. Regional lenders suddenly collapsing under duration risk. The cause, they say, was interest rates. Bonds lost value. Depositors moved to safer places. But the deeper cause? A century-old structure that rewards short-term expansion while guaranteeing systemic fragility. It's the same performance, only the cast has changed. Instead of Morgan, we have the Federal Reserve. Instead of gold drains, we have digital withdrawals. Instead of panic in Manhattan, we have contagion through screens. But the choreography, over-leverage, loss of trust, concentration of power, remains identical. Here's the uncomfortable truth. Every panic is a power transfer disguised as chaos. In 1907, power moved from private banks to the idea of a central bank. In our time, it's moving from regional lenders to the largest institutions, those too big to fail that now resemble 21st century empires. When you hear that regulators saved the system, remember, they didn't save everyone. They saved the structure. Look closely and you'll see it. The 1907 blueprint reappearing line by line. The slow erosion of liquidity, the flight of deposits, the selective rescue, and finally, the new order rising from the ashes. Because panics don't destroy systems, they reorganize them. To understand the present panic, we have to go back, not to Silicon Valley, but to Wall Street, 1907. There was no Federal Reserve then. Money moved like blood without a heart, pumping through private banks, trust companies, and clearinghouses that depended on each other's honesty more than on any law. It worked until it didn't. In 1906, the San Francisco earthquake hit. Insurance companies in London and New York had to pay out hundreds of millions in gold. The American financial system began bleeding reserves overseas. At the same time, the U.S. economy was roaring. Railroads, steel, new cities. Money was everywhere, but it was borrowed money. When the quake struck, the thin layer of confidence that covered the system began to crack. By October 1907, the trigger came from something small, the failed cornering of United Copper stock by F. Augustus Hines, a mining magnate who also happened to control several trust companies. When the scheme collapsed, depositors lined up outside Knickerbocker Trust Company, then the third largest in New York. Within hours, $8 million vanished in withdrawals. The next morning, the lines spread to other institutions. Panic had gone viral in the pre-internet world. Here's where the system revealed its hidden architecture. There was no lender of last resort. There was only one man, rich and connected enough to act like one, John Pierpont Morgan. 69 years old, cold-blooded, with a crimson nose and a personal library where he would now stage the most consequential private meeting in U.S. financial history. Morgan summoned the heads of every major bank, railroad, and trust into his home. He locked the doors, literally, and told them no one would leave until they decided who would be saved and who would be sacrificed. The Treasury Secretary sent $25 million in government deposits to backstop the private rescue, but the real money came from Morgan's network. The panic wasn't solved, it was absorbed. And when it ended, the conclusion was clear. The U.S. needed a permanent version of Morgan. That's how, 6 years later, in 1913, the Federal Reserve was born. The official story said it was to stabilize the economy. The real story was that private banking interests had learned a lesson. Never let a crisis go to waste. The same people who had nearly destroyed the system now wrote its new rules. Senator Nelson Aldrich, father-in-law of John D. Rockefeller Jr., chaired the secret Jekyll Island meeting where the blueprint of the Fed was drawn. They called it a central bank, but in essence, it was a cartel of regional banks designed to prevent panic by controlling panic. They created 12 regional reserve banks, a democratic facade, but the power was concentrated in New York, where Wall Street dictated monetary flow. From then on, every crisis could be managed. Liquidity could be conjured. Credit could expand beyond gold, beyond reality, as long as confidence lasted. What emerged was not stability, but control disguised as stability. The Fed was not born as a neutral referee. It was born as the institutionalized will of private finance, wrapped in the flag of public good. Morgan's library had simply been replaced by marble halls in Washington. Now remember this architecture, because in 2024, when regional banks began to fall one by one, it wasn't random. The system was designed to centralize power through selective rescue. The regional model of 1913 was already an illusion, and today that illusion is breaking the same way it did in 1907. The difference? Back then, gold was the limit. Today, it's trust. And trust, once lost, cannot be printed. Once the Federal Reserve was created, America entered what economists later called the Age of Confidence. The headline said the system was finally immune to panic. There was a lender of last resort, a flexible currency, a scientific way to manage credit. To the public, it sounded like alchemy, turning fear into stability through bureaucracy. But to those who built it, it was something else entirely, the institutionalization of leverage. The 1910s and 1920s were the first great test. The Fed opened its vaults and money flowed. Low rates fed speculation. Wall Street flourished. Corporations merged into conglomerates. Banks expanded their branches. And ordinary Americans, for the first time, began to invest in stocks. Prosperity was marketed like a product. Buy now, pay later wasn't yet a slogan, it was the new religion. The press called it the new era. Politicians called it the triumph of American finance. But behind the optimism, the same dynamic from 1907 was back. Capital pooling in fewer hands, liquidity growing faster than real production, and risk shifting invisibly from center to periphery. The Fed's own structure, those regional reserve banks, became decorative. New York's Federal Reserve, under Benjamin Strong, effectively was the Fed. When London or Paris needed stabilization after World War I, they called New York, not Washington. The empire of credit had replaced the empire of gold. The illusion worked because it made people feel rich. Money supply rose, interest rates stayed low, and every crisis, a war, a recession, a crash in farm prices, was contained. It was the same psychological mechanism as 1907, but reversed. Back then, fear spread from bank to bank. Now, confidence did. The public believed the Fed could always smooth things out. Then came the metaphorical champagne moment. The 1920s stock boom, a decade of jazz and skyscrapers, financed by margin loans and easy credit. When you bought a share of U.S. Steel or General Motors, you didn't pay the full price. You borrowed. Everyone borrowed. Brokers borrowed from banks. Banks borrowed from the Fed. It was a pyramid built on the promise that nothing could go wrong, because the new system had been engineered to prevent collapse. Sound familiar? It's the same narrative that surrounded tech startups and regional banks a century later. safe, modern, scientific, until the math turns against them. What made the illusion powerful was its moral packaging. Central banking wasn't just finance, it was progress, patriotism, even morality. Stability became a national virtue. The public didn't see the quiet concentration of power, they saw the miracle of endless growth. Morgan's library had turned into the Fed's balance sheet, and people believed it was infinite. That belief, not gold, not credit, was the real reserve. The system could expand only as long as people trusted that someone, somewhere, could control it. And for a time, it seemed they could. It's a familiar rhythm. You've seen it in the dot-com boom, in subprime mortgages, in crypto bubbles. Every era rediscovers the same formula: more credit, less caution, and a central authority ready to manage any fallout. Each time, the players are smarter, the instruments more complex, but the story identical. By the late 1920s, the illusion was so complete that even when warnings came, from economists, from foreign banks, from gold outflows, they were ignored. How could there be a panic in a system designed to prevent one? That's the paradox of every engineered economy. Success erases the memory of risk, and confidence becomes the most dangerous leverage of all. Look closely at any boom, and you'll see the ghost of 1907 smiling. Because when a system stops fearing collapse, that's when collapse is already on the way. By 1929, the illusion had reached its mathematical limit. The market capitalization of U.S. stocks had tripled in less than 5 years, while industrial output barely grew by a fraction. The average share was selling at 25 times earnings. But no one cared. The new managed system, they said, made numbers irrelevant. Permanent prosperity was the phrase of the age. The same way, a century later, we were told that tech valuations or zero interest rates were the new normal. Then, as always, the arithmetic returned. In the autumn of 1929, margin calls started to pile up. When brokers demanded repayment, investors had to sell shares. Prices fell. That forced more margin calls. Liquidity, the oxygen of illusion, vanished overnight. In 3 weeks, the Dow Jones Industrial Average lost nearly half its value. The pyramid inverted, and the entire credit structure collapsed under its own weight. The Federal Reserve, this great machine born from the ashes of 1907, stood frozen. Its regional governors were divided. Some feared inflation, others deflation. All were paralyzed by theory. The same system that was supposed to prevent panic now transmitted it nationwide. Between 1930 and 1933, over 9,000 banks failed. Depositors lost life savings, farmers burned crops to keep prices up, and industrial output fell by half. The illusion of control disintegrated in public view. This is when we learned the cruel equation of monetary systems. Confidence equals liquidity. Loss of trust equals mathematical collapse. Arithmetic has no sympathy for ideology. When liabilities grow faster than assets, the reckoning is not political, it's physical. But politics refused to accept that. Instead, it tried to rewrite the math. The Roosevelt administration, facing mass unemployment and social collapse, abandoned the gold standard in 1933. Overnight, every dollar was devalued. Citizens were ordered to turn in their gold under Executive Order 6102. The government promised it was a patriotic duty, but in truth, it was a forced reset of the same structure built after 1907. Private wealth was pulled into the hands of the central authority, again, under the flag of saving the system. Gold was replaced by government credit. The new foundation of trust wasn't metal, it was narrative. The dollar is as good as gold, they said, but only because you couldn't redeem it anymore. The illusion was reborn in fiat form. The Depression taught the elites a painful but valuable lesson. Collapse isn't the end, it's an opportunity to redesign ownership. Wall Street, broken in 1930, reemerged in 1934 with tighter federal control and deeper ties to Washington. The Fed gained new powers, the Treasury became the ultimate backstop, and the public, the depositors, the savers, the taxpayers, became the involuntary guarantors of a system that had already failed them. Now look at the pattern. 1907 panic, centralization, illusion of control, 1929 collapse, deeper centralization. Each crisis didn't destroy the architecture, it upgraded it. Every failure justified more power for those who designed it. Fast forward to 2023-2024, when small banks started breaking again. The headlines sounded eerily familiar. Confidence issue, liquidity stress, temporary shock. But beneath those phrases was the same arithmetic. Regional banks, overexposed to low-yield assets, saw depositors flee. The Fed raised rates, the math broke, and once again, control consolidated upward. J.P. Morgan, the name from 1907, absorbed yet another fallen institution. You can almost hear history whispering, same script, different century. When the numbers stop obeying the story, power steps in to rewrite the story. But arithmetic always wins in the end. It did in 1929, it will again. If you fast forward from the Great Depression to now, more than a century later, you'd think the lessons were learned. We have deposit insurance, we have instant liquidity, we have regulators watching every ratio, every reserve requirement. But in truth, the system has simply evolved into a more elegant version of the same 1907 machine. Same leverage, new interface. Look at the pattern in 2024. Silicon Valley Bank, First Republic, Signature, New York Community Bank Corp. Names that sound modern, but their death sentences were written by the same logic as Knickerbocker Trust. They grew too fast on promises, lent against assets that looked safe when interest rates were near zero, and assumed confidence would last forever. The difference now is speed. In 1907, rumors spread by telegraph and newspaper. In 2024, they spread by group chat and push notification. What once took days now takes hours. When depositors at Silicon Valley Bank realized their money was trapped in long-term treasuries, bonds that had lost value as rates rose, $42 billion left in a single day. It was the first digital bank run in history. That's not progress. That's 1907 with fiber optics. And who stepped in as the modern J.P. Morgan? Not a single man in a library, but the same names: J.P. Morgan Chase, Citigroup, Bank of America, Wells Fargo. The new Trust Consortium, deciding which regional banks to absorb and which to let fail. The Federal Reserve, born to prevent concentration, now acts as the legal cover for it. In the name of stability, competition dies quietly. Even the bailout structure is identical in spirit. The Bank Term Funding Program of 2023, designed to let banks borrow against underwater assets at face value, was a digital echo of Morgan's emergency loan pool in 1907. Same intent: freeze the panic long enough to rearrange ownership. The beneficiaries are the same too. When smaller institutions fall, deposits migrate upward, to the largest banks, to the treasury market, to the same centers of control that have existed for a century. The losers are always the periphery: regional lenders, local economies, the real businesses that actually produce goods instead of managing balance sheets. And the moral cover story remains identical. In 1907, they said, "We're saving the economy." In 2024, they said, "We're protecting depositors." In both cases, the outcome was the same: concentration of credit power into fewer hands and the quiet expansion of state-corporate partnership over private capital. It's tempting to call this evolution, as if the system learned, but what it really did was automate the old panic script. The difference between 1907 and 2024 isn't structural, it's theatrical. The panic is now managed through dashboards instead of headlines. Liquidity is conjured by keystroke, not by telegram. But every conjuring act depends on the same illusion, that infinite debt can coexist with finite trust. The Fed's balance sheet tells the truth no press release can hide. Trillions in assets accumulated after each crisis, 2008, 2020, 2023, each time promising it was temporary, each time becoming permanent. The temporary rescues have become the permanent architecture. So when we say the 1907 blueprint is visible today, we're not being poetic. It's visible in the structure itself. Trust collapses at the edges. Power consolidates at the center. And each collapse justifies more control. The cycle hasn't ended. It has been digitized. If you're hearing this in 2025, know this. Every rescue you read about is another page from the same century-old playbook. They call it stability, but it's really selective survival. If this part helped you see how today's financial world is a mirror of 1907, drop a comment below. Do you think the next reset will still be called a rescue or something else entirely? We began with a paradox, that the panic of 1907, instead of being buried by history, became the operating system of modern finance. And now we see it clearly. Every reform meant to prevent crisis has merely institutionalized it. The machine feeds on its own breakdowns. Look closely and you'll notice, it isn't really a financial story anymore. It's civilizational. In 1907, a handful of bankers in New York decided which firms lived and which died. In 2024, that power is exercised through algorithms and committees, but the essence hasn't changed. Control has become more abstract, but not more accountable. What used to be smoke-filled libraries are now data centers humming with invisible decisions. The public still watches from outside the glass. This is the hidden logic of money. Every expansion of credit is also an expansion of obedience. Because when money is based on trust, whoever controls trust controls the world. And that's why every panic, 1907, 1929, 2008, 2023, ends the same way. Not with a reckoning, but with consolidation. The crisis is never wasted, it's harvested. Arithmetic doesn't care about ideology, but ideology always tries to outtalk arithmetic. Politicians call it stabilization. Economists call it policy transmission. But the truth is simpler. If promises grow faster than production, if paper multiplies faster than goods, something must break. You can legislate confidence, but you can't print reality. So where does that leave us now? We're standing at the edge of the same equation Morgan once faced. Only this time, there's no gold, no restraint, only digital entries and faith in central management. And yet, deep down, we know the pattern. The numbers will again outgrow the trust that sustains them. Here's the moral hidden beneath a century of technical jargon. Systems don't collapse because of villains or conspiracies. They collapse when mathematics outpaces belief. When trust, like gold once was, becomes too scarce to back the promises piled upon it. If you followed this far, remember, history doesn't repeat, it compounds. Every generation adds leverage to the last. The 1907 panic never ended. It simply changed its name, its language, its interface. And if you're watching this in 2025, understand what that means. We're not awaiting a new crisis. We're living inside one that never stopped.